Excellencies, ladies and gentlemen, colleagues, thank you very much for coming today. So numerous of you. We are very happy to see all of you here. And we also have the privilege to receive among us today a key player of the Eurozone, Professor Pier Carlo Padoan, the Minister of Economy and Finance of Italy. Professor Padoan has been the Minister of Finance since 2014 in the government of Prime Minister Matteo Renzi. And in this capacity, he of course participates in the Eurozone meetings, Eurogroup, where the future of the common currency is being discussed. Professor, I think you have many compatriots in the room, but for those of you who are not Italians, please may I remind you that Italy, with 60 million people, is the 4th largest economy in the EU and the 8th largest economy in the world. So we know that the EU, and particularly the Eurozone, has been going through serious turbulences since 2008, when the world crisis started in the United States. It has then developed into the Euro crisis, where we saw that the euro, or common currency, had some serious structural weaknesses. But since then, the euro crisis has been high on the political and economic agenda, including here in Asia, but the EU is getting its act together. Europe took unprecedented measures to address this difficult time and period and to strengthen the single currency, from the European Banking Union to the European Stability Mechanism, and more recently to the European Central Bank large purchase of bonds. Clearly the crisis, the Eurozone crisis, like every crisis in the construction of the European Union, is an opportunity to deepen integration and to strengthen the bonds that link the different member states. We are a little bit late, so I will not make it longer. Professor Padoan, of course, has a prestigious career, and you have all his resume in front of you. Let me just say that he was professor of economics at the University La Sapienza in Rome. He was Deputy Secretary General of the OECD, Italian Executive Director at the IMF, economic advisor to several Italian prime ministers, and he also held several academic positions in the College of Europe in Bruges and also at the University of Tokyo. Professor Padoan will speak for about 20 minutes about the outlook of the monetary union, and I'm sure he will cover other subjects which are of high interest to all of us. And this will be followed by the Q&A session. Professor Padoan has kindly accepted to stay 10 minutes longer than what we thought, so we will have the time for the Q&A session. So please join me in welcoming now Professor Padoan.
Good afternoon to all of you, and thank you very much for kind words of welcome that you just pronounced. Let me first of all take this opportunity to express to you and to the people of Singapore my deepest condolences to the recent loss of your country's first Prime Minister, Mr. Lee Kuan Yew, to whom this School of Public Policy is dedicated. In his struggle for the independence and the foundation of the Republic of Singapore, Mr. Lee Kuan Yew has shaped the country in a way few people have any nation, to build one of the most prosperous economies in the world today. Singapore indeed has shown a remarkable resilience to the first wave of the financial crisis in 2008 and 2009, with a string of positive and increasingly sustained growth rates over the last 5 years. Different has been the scenario in Europe, where the sovereign debt crisis has slowed the recovery from the crisis. However, now signs of recovery are spreading across countries and indicators. My remarks today will address some aspects of the crisis of the euro area that are likely to remain a prominent feature of the debate of European integration for quite some time. The crisis of the EMU started in 2010. Its unraveling since then has meant for the economic and monetary union the risk of reverting into an economic and monetary disunion. Conflicting views within national borders and across countries have called into question the project of European integration as had never happened before. The European disintegration forces have grown over time, and today they're still present. However different they may appear, their common denominator is the lack of reciprocal trust among countries, which amounts to a risk of regression to the traditional national mindsets and prejudices that have dominated Europe for centuries. The response to these disunion forces must therefore be one of confidence rebuilding and of diffusing national prejudices. Trust and confidence building are instrumental to understand not only how we got into the crisis, but also how we can get out of it finally, and what are the prospects in front of us. So let me talk a little bit about trust. EMU was thought from the beginning as a confidence-building tool to help overcome historically entrenched mistrust among European countries. Indeed, the very idea of money is built on the notion of trust. EMU represents the institutional answer to the failure of previous experiments of monetary integration based on supposedly irrevocable fixed exchange rate agreement, such as the European monetary system. Irreversibility is thus a characterizing element of the euro and of monetary union. The crisis, however, has shown that the euro too could be irreversible and vulnerable to the same impossible trinity which was at the basis of building monetary integration. As you all know, the impossible trinity states that we cannot have at the same time independent monetary policies, fixed exchange rates, and full capital mobility. One of these three, at least, must yield. And this is why Europe decided, after the failure of the European monetary system, to go towards monetary union. Now, it is a fact that the lack of confidence in the euro produced fragmentation in the euro area itself, and so challenged the idea that overcoming the impossible trinity on a supranational strategy approach was indeed possible. So, in 2010, at the height of the crisis, we observed the paradox of a single currency with different and separated national money markets. Bank liquidity was de facto ring-fenced within national borders, and so banks belonging to the same company actually followed different lending practices according to where they were geographically located. Many things have changed since then, but the risk of fragmentation has not gone away fully yet. Fragmentation is further led by lack of trust, and in trust, lack of trust feeds fragmentation. This is why rebuilding trust is essential to the future of monetary union, because without lack of trust, the hope to defeat definitely the fragmentation risk is frustrated itself. So leaving behind the EMU crisis requires replacing a vicious circle originated by the mistrust fragmentation sequence with the virtuous circle sequence trust mutualization sequence. This is to me the key challenge. I mentioned the notion of mutualization. I will return to that in a minute. To me, this is the key word to gain the final irreversibility of monetary union and therefore complete the trust-building exercise that Europe is now facing. Of course, mutualization has pros and cons. And one can easily trace back to the current policy debate the issue of mutualization from two different perspectives. Mutualization is seen as a negative if people see risk pooling, which is an implementation of mutualization, as bearing moral hazard risks to the fore. And therefore, from that point of view, mutualization should be rejected to avoid moral hazard. At the same time, mutualization implies the positive benefits of risk sharing. and deciding whether or not we need more risk-sharing and risk-sharing instruments and institutions in monetary union. So this is the real challenge I see today, both from a perspective of a scholar and also a perspective of a policymaker for the time being. And indeed, my experience as policymaker has reinforced my conviction that the big issue in European construction is how we rebuild common trust among European countries. Lack of trust as an additional drawback, which you can find in almost all decisions of policymaking we take in Europe. Lack of trust shortens or shrinks the decision-making horizon to the short term, towards the short term, and therefore raises the risk of pro-cyclical policies that may magnify instead of reducing external shocks. This is how the vicious circle of lack of trust and fragmentation feeds up. It shortens the time horizon, which is exactly the opposite we need if we have to build Europe in a long-term perspective. So, where do we stand today in terms of dealing with lack of trust and dealing with the challenge of mutualization? Much has been done, and this was reminded by our kind host, since 2010. If you go back to 2010, European Union looked much different from what it is today. In terms of confidence building, much progress has been achieved in spite of the depth of the crisis. And this has also translated into very concrete examples in terms of institution building. In a way, building common institution is the concrete sign that there is mutual trust. We build common institutions because we think we need to do things together. And of course, the most, but not the only one, a clear example of that is banking union. Banking union today is a long way towards being completed. We have a single resolution fund, we have a single supervisory mechanism. We don't have one thing, which is a common deposit insurance scheme. And this is not by chance that we still do not have that key element of a banking union, because this is possibly the area where mutualization is most needed. At the same time, mutualization is being built through banking union elements, which may sound very technical. Indeed, they're sometimes very difficult to understand, even at the policy-making level, but they do imply mutualization making progress. Without that, we would not have banking union as it is today. One example, the Single Resolution Fund, which pools together resources to deal with possible banking crises, which are always a possibility, of course, starts with national contributions that eventually stop being national money and become a European money. This is not much money. We're not talking about big numbers, but we're talking about big principles. And it is not by chance that, in my experience, agreement on the path and intensity of that process towards building a common resolution fund has been highly difficult, and it always boils down at the end of the day, at the end of the meeting, to the amount of risk sharing that countries are willing to agree upon, and to the amount of common resources being devoted to something which will transform German, French, Italian, Spanish money into European money. It may sound paradoxical, but this is what we're talking about. There is another example which is more recent. We all, I think, in all this room, certainly on my side, we welcome very much the decision of the European Central Bank to move towards QE, European style. Those who like to see the glass half empty have pointed to the fact that the amount of mutualization in common monetary resources has been limited, and most of the resources involved in the QE mechanism have to do with national resources targeted at national markets. This is true. In spite of that, QE is probably working well, and at the same time, some element of mutualization is present in the QE mechanism. So we are making steps towards a de facto mutualization of resources through banking policy, through monetary policy. Why am I saying this? Because I strongly believe in the fact that in spite of all the difficulties we're facing, Europe is going in the right direction. And this is also a sign that the risk of disunion is being de facto challenged. However, this is not enough. We need to do much more. We need to build a new policy mix in Europe which takes mutualization further down. And a policy mix is a much more complicated challenge than only just restating, and reshaping and resetting monetary policy. Of course, the new monetary policy stance is an essential part of the new policy mix. And by chance, again, not by chance that this comes out of a very strong supranational institution. But the question is, what should countries do in this policy mix? First of all, let me take a step backward and draw your attention to the fact that we are talking about new policy mix in Europe only recently. If you go back to the policy debate about what European countries should do, say 12 months back or 18 months back, then the immediate word that would come to your mind, I guess, would be austerity, yes or no. But this was the crux of the discussion. Now, the focus of economic policy discussion in Europe, to me at least, has shifted towards other keywords, such as investment, such as growth, such as jobs. So the policy debate, and again, this, I can testify, is reflected in what ministers discuss when they meet in the Eurogroup or in ECOFIN, is shifted towards things that have to do more about everyday life. Hopefully, a new policy mix will sooner hopefully than later, will deliver more jobs and more confidence in the European projects. So what is the new policy mix about? It's about fostering growth, which has been declining not just because of the financial crisis, but also because of longer-term structural impediments. It's about investment. It's about enlarging the single market. And these are the chapters of the new policy mix where I see new hope for further mutualization. Let me start with examples that may sound far away from the notion of mutualization. Macroeconomic policy. One feature of a macroeconomic policy adjustment mechanism within the Eurozone is asymmetry, meaning that not all countries in the Eurozone are adjusting to the needs of a crisis which has revealed very deep imbalances in monetary union, imbalances which economists, including myself, never think would happen in monetary union, mainly caring about current account imbalances within monetary union. We seem to think, we as economists, we used to think that with monetary union those problems would go away. Wrong. They have come up with a vengeance. So we have a macroeconomic policy agenda in the monetary union which needs to be tackled, and so far it has been tackled mostly in an asymmetric way, meaning that the burden of adjustment has fallen largely, if not uniquely, upon debtor countries with current account deficits requiring financing coming from outside. So we need to be more symmetric. We need surplus countries to do more, and you know which countries I have in mind. This is part of the macroeconomic imbalance procedure, which is a new part of the macroeconomic surveillance mechanism, which has been introduced not without a chance as a consequence of the crisis. Are we making progress there? Hopefully so. We will see how the Commission implements the principles that are written down in the macroeconomic imbalances procedure. So there is some hope of mutualization there in terms of understanding that within monetary union it's not just a matter of national economies adjusting, it is also a matter of the system adjusting. We can have different macroeconomic adjustment paths that can generate a lower or a higher level of aggregate fiscal stance and aggregate demand in monetary union. According to the way this is dealt with, we can speak of more or less mutualization in macroeconomic adjustment. On the supply side or structural side, structural reforms have become, rightly so, very much on the top of the economic policy agenda. And now the discussion is not so much whether or not countries should introduce structural reforms, but number one, to what extent those reforms are implemented, and number two, to what extent reforms in one country spill over to the neighboring country. And spillovers are there for sure. If we believe that structural reforms boost potential growth in the medium term, by definition, this spills over to my neighbor in monetary union. So there is a scope for looking at to what extent structural reform, national structural reform agendas can be looked at from a systemic point of view, and therefore there is a mutualization in terms of the benefits of structural adjustment in all of the economies. All of the economies, not just some economies, need to undertake structural adjustment. Investment. Again, there is a mutualization dimension there. Investment has been going down dramatically as a consequence, but also as a cause of the crisis in many areas, certainly very much so in Europe, both public and private. We need to boost investment. We need to boost private investment, and this links up with the structural reform agenda to some extent. We also need to boost public investment. This is where the so-called Juncker plan comes in. Hopefully, once it is put in place, it will indeed provide additionality, meaning it will mobilize private investment that would otherwise not be activated because of market failures in the investment markets. So let's hope that this new instrument, which is very welcome, is actually implemented. And certainly the job of the governments and of the ministers is to see that the bureaucracy mechanism attached to that is as light as possible, it is as quick as possible, and it is efficient as possible. But there are other areas. One area which I always like to remind when I talk about these issues sounds very old-fashioned, the single market. The single market is, at the end of the day, one of the most powerful growth machines that Europe can count on. And the single market is far from being completed. There are a number of chapters in the agenda of the new Commission which are welcome. The energy single market, we badly need an energy single market in Europe. The digital single market, which is instrumental for boosting innovation capacity, among other things. And a capital single market. Now, think of the single market also from another point of view. The single market is a growth machine for the euro area, but it's also a growth machine for the European Union. And this is where we have to be more explicit about another challenge which has mutualization implications. What is and what will be the relationship between the euro area and the European Union, and all those countries that we know will never, in the likely future, join the euro? This is a very important challenge which raises the longer-term issue of to what extent Europe, and not the euro, Europe is an attractive incentive for countries to participate. And it is, of course, coming up strongly in the political debate in many countries. And you know which countries I have in mind. So the issue of exiting Europe from different doors is broader than we tend to think. And this is something that has to do with the future of mutualization and how mutualization can help. A country would, rightly so, decide whether or not Europe is a good idea, also according to a broad-based cost and benefit analysis, including to what extent is a country willing and wishing to share something with other partners in terms of what are the returns, mostly returns in terms of, I guess, jobs and welfare for citizens. Last point, not really the last point, but next to last point in my mutualization list is a dimension which is at the very heart of this single market, and even more so than monetary union, and that's labor markets. You all know that the traditional approach to monetary unions, which was based on the so-called optimum currency area principle, stated very strongly that if you give up the exchange rate to adjust your economy, then you must find flexibility somewhere else. And that somewhere else is usually, mostly, the labor market. Now, the issue here is complicated. I think that it's appropriate to have more flexibility in several national labor markets, certainly including in my own country, and this is why we have introduced a major labor market reform. But we also must recognize, or should recognize, that there is a supranational dimension to labor market adjustment in monetary union. There is a lot of scope for ideas about mechanisms that provide risk-sharing mechanisms for unemployment, especially at the time in which unemployment still is so large and wide in Europe. This is a theme which is economically and socially ripe. Maybe it's not ripe from a political point of view. During the Italian EU semester, we organized an informal session where all finance ministers participated, and it was a very lively discussion about a proposal to set up a common fund for helping unemployment situation in countries belonging to monetary union. The response around the table, since it was an informal discussion, was that there was a huge interest from my ministers, my colleague ministers. But of course, this was politically not ripe yet. Now, of course, politicians often decided that everything is ripe. But this, again, I take as a positive sign of the fact that there is willingness to discuss this dimension of mutualization, which would really signal a step forward. Final point, and I'm really finished, is that there is an area of policy mutualization which is the most delicate and crucial one, at least as crucial as the labor market dimension. That's fiscal. By fiscal, I mean a long list of issues, including the different things one may think of when the word Eurobond is put on the table. It used to be an unpolite word. One would not pronounce the word Eurobond in a public debate about Europe because it immediately evoked different reactions around the room. But fiscal mutualization is the ultimate step towards union for many different reasons I will not dwell upon. But of course, next and after or immediately in parallel with fiscal mutualization, let's face it, let's be very frank about it, stands the ultimate step towards sustainability of monetary union in the long term. That's political union, because of the obvious political implications of sharing resources at a common level, and not just the EU budget as it stands today, but moving much more towards fiscal integration and accepting the idea that some fiscal problems are common problems, not just national problems. This is the ultimate step. But after all, let me finish with one observation on historical evidence. In history, if I'm not wrong, the only monetary union which have survived are those that eventually evolved into political union. So this as a lesson from history that I like to keep. Thank you very much for your attention.